Now that we've talked about oil and looked at some of the oil demand and some of the places that we see problems going forward, now we can turn to the US and start to look at the biggest driver of not only US GDP, but also US oil consumption is going to be the retail side, the consumer. So the big thing that we want to look at here is the top two parts. So the top one is what's called core. So when we look at core retail sales, we're going to take out food services, auto dealers, building materials, gas station, look at what is the core component doing, because this was the source of a lot of bullishness as we went through and came into not only June, July, but then August. And you can see that it's actually negative, and it actually fell below estimates. Now, this is a problem just because we're starting to see the effects of not having stimulus, people starting to pull back on spending, which is something we're going to talk about a bit more. And this is going to be that overhang when we talk about how can the economy really get back to normal when we need so much stimulus to keep people spending, to keep things moving. And again, that's going to be the overhang as we go forward. Now, when we start to look for the adjustment overall, now in this one includes adjusted retail and food service sales. You can see that it was only increase of 0.6. The expectation was for 1. So again, we missed across the board. And it just means that people are really starting to pull back, really starting to normalize as we go through the fact that we still don't have a stimulus package. The expectations of one coming before the election continue to look less and less likely. We had commentary today about the potential for a $1.5 trillion bill that maybe would come before the election. It just doesn't seem likely until after we have that election. And then the other thing is going to look at when we look at the MBA US mortgage market index, and you continue to see it slow down. Again, we had a huge spike. People that could move did move. They applied for mortgages, then they got approved, and now we will talk about Europe for a minute later on. But we also talked about how U.S. Lending standards were starting to get tighter, and we're starting to see that, which again is putting that weight on just where we see the mortgage applications. Again, we're also getting into September, October, where there's just less home sales, so that's something to consider as well. But again, it's just that trend is just looking at the overall consumer, especially when you consider money's free. People are looking to buy homes, and you're starting to see some of this rollover, which again is going to be a problem as we go through the remainder of not only Q3, but then into Q4 without any type of stimulus, especially as the job picture continues to worsen. And that's when, again, looking at those home sales, the home sales continued to rally. And that's where we've had the home sales, we had the MBA mortgages, but also foreclosures and mortgage delinquencies continue to go higher. That is going to be a problem when we consider what is going to happen with delinquencies, because we've seen an increase in that 90-day. We see an increase in just that stress, and people are actually starting to Google foreclosure more and more as they get those notices to figure out what happens next, what rights do they have, because there was a moratorium put on foreclosures, so you can't kick anyone out of their house or apartment until next year. But again, the proceedings are starting. This is going to be set in motion, which is just going to put more supply on the market as we go into 2021. Now, on the positive side, the September Empire Manufacturing Index, we came in at 17. The expectation was for 6.8, and the prior month was at 3.7. So you can see that, again, positive moves. We're seeing a little bit more manufacturing. We're seeing people feel a little bit better. Like we had home builders at the highest level in terms of how they feel about the market. So there is some bright spots. The question is going to be which one wins out, and we're always going to side with the consumer. But just because they're obviously the ones with the purse strings, they're the biggest drivers. But again, these are things that start to make people feel better. Maybe their jobs will be safe, or they'll get hired back, and that's why it's important to look at this. The yellow line is looking at the number of employees. Now it's back to an expansionary level, but you can see it's starting to flatten out. And the problem is we see that rolling back over into negative territory just because we don't see the same type of drive. Citibank has announced that they're going to have additional layoffs now that the freeze is over. And we see banks starting to announce additional layoffs. We see other companies, the large companies, announcing additional layoffs. And the problem is these are not people that are making $25,000 a year. These are people making $150,000, $250,000, $350,000 a year, which again, these are the people that are driving spending. They have the most discretionary cash. So the fact that we're going to lose some of that, or at least people aren't going to feel as confident, that's going to be a bigger overhang as we go through the remainder of the year. Industrial production missed estimates. It rose by 0.4%, but it was supposed to be 1% was the expectation, and it was 3.5% last month. This is what we were talking about when we had some of this rollover as we came through August. We were expecting something to weaken. We did think it was going to be positive, but again, 0.4% was kind of where we thought things were going to happen based on PMI, ISM, where we look on exports and imports, we look at intermodal. These are things where we're just seeing some of that industrial production continue to slow after we had that nice bounce, which again is starting to show up. Now, you have to look at the U.S. empire. Manufacturing is looking at more of the Northeast, looking at things in different ways. So that's why this is looking at the aggregate, and you can see that overall things are starting to hit some of these headwinds, which we've talked about, where again hitting this plateau, kind of flattening out without any real drive to kind of get over that hump as the consumer continues to struggle. Now, the Atlanta Fed GDPNOW index is trying to calculate in real time what Q3 is going to look like, and it had a little bit of a bounce. You've seen it's had a nice little move higher. The problem is going to be that PCE number, the personal consumption expenditures, and that's where we see some of the biggest headwinds as we go forward. Now that we've seen some of the fiscal stimulus run out without any new stimulus, this is where we think you're going to start to see some of those slowdowns. Now, again, we're not talking about a huge correction down, but it's just we think we're going to start to normalize, just below that 30% as we see some of these other headwinds start to get factored back in, because this is calculated about twice a week. So again, it's just going to be the kind of see some of those headwinds coming through as the headwinds continue on the employment side and then the spending side. And here's where we talk about those job cuts again, because the job cuts is just looking at across the different industries, and the financial services is one that's is going to continue to grow as we have a new round of layoffs, as we have some of these individuals that are, as they start going back, are going to face additional layoffs. The pandemic loss, and now you can see that it's just about half of it as still remains, except for that IT side, which it comes down to the companies used COVID as a means to fire people and to let people go. And that's why things were already struggling. Revenue was already a struggle. So that's already showing here. And we just don't see much recovery when we look at some of these areas. So when we look at business closures overall, and we continue to see the increase nationally, this is coming from Yelp. So this is looking at what has happened on a total level. In terms of closures, you can see a lot of it was initially temporary, then not as much of it was permanent, and now we're seeing some of those permanent numbers increase as temporary becomes permanent, and those totals start to kind of drift higher. As just there's only so much you can do with small business loans, PPP loans, and that's the pressure that we're starting to see, where you're starting to see this creep higher as companies just rationalize, saying that, look, we can no longer continue under these current levels. So what is the breakdown as we look at restaurants and retail? And you can see that the temporary closures and permanent closures, again, seeing this turnaround. This comes to landlords, this comes to rent, this comes to tax revenue. This is why a lot of these urban areas are going to struggle to see some of these some of this tax revenue, which is why the municipality shortfalls is going to be something to watch as we go into 2021 and budgets start to get worked out to see how can they really kind of fill the gap, because you still have a lot of unemployment, you still have benefits to pay out, but yet you have these permanent closures, you have this loss of tax revenue, which is going to be that overhang. And now when we talk about, just kind of rounding out spending, it's important to appreciate that 40% of households by income account for around a fifth of the aggregate consumer spending. And here's where, when you look at it from 2018, so looking at 2018, which was a very strong year, you had the lowest together, the lowest 20% and that 40% accounting for 22% of total spending. Now, those are the ones that have been impacted the most when we consider what spending looks like. So they've dropped off more aggressively. The issue here is also the highest 20%, because we're starting to see more softness in that quartile, which typically is a bit more impervious, or at least has some staying power, versus that lower entity. And as we see that discretionary income come away, that's where we're going to see additional bite out of consumer spending overall. And that's where we look at that shrinking paycheck to see the cuts to earnings, because not only are people faced with losing their job, but if they were furloughed, maybe you got a percentage of your salary. And at the same time, maybe you just had to accept a lower paycheck because you're now unemployed and you're getting towards the end and you just want to get back to work. And here you can see the breakdowns in terms of experienced loss of employment since March 13th, but expect to lose employment in the next 4 weeks. And you can see many people still expect to lose their jobs going forward, which again is going to put additional headwinds in terms of total spending. Now, when we look at total spending, again, it's going to come down to what are people spending on? How do they feel going forward? And here you can see mortgage delinquencies continuing on that 90-day level. And that's where we start to see those increases. You're seeing people going from that 30 and 60 to that 90-day. Now, the foreclosure process will remain low, but we're starting to see those increases, and we keep seeing the mortgage delinquencies increase, which again is just going to put an overhang on that total entity. And just rounding it out, when we talked about people searching for and Googling what do foreclosures look like, what is that, how does eviction work? What is the legality? What do I have to do? What's next? This is usually people getting those notices, and it's going to be indicative as to what's going to happen, how bad could this be. And this is just something to watch, something interesting to watch as we look at searches increasing, people struggling to pay their bills, spending slowing down, and just that job loss. So these are things that we're going to look at. And in the next segment, we're going to talk on trade, what is happening in trade, because that's going to give us kind of a look forward as to how bad could this get based on imports, exports, and what does the global market really look like for some of our products to kind of support our manufacturing and just inherent job growth, which remains lackluster at best.